There's no bigger gold bull than me. I mean, I think we're going to 3,000 within the next 6 months. I think we're going to breach that. Gold is so deeply undervalued, it's insane. It needs to be in a different zip code. So I see 4,000, 5,000. At the end of the cycle, it could be 20, 40, 50. I mean, you know, which sounds absurd, but it's not. It's really not. I mean, if you take it and if you did the math the way we did it in 71 when we were on a gold standard, you know, Brent's done this actually, you'd need to be at $79,000 per ounce gold. Now, you don't need to have full coverage to be on a gold standard. Yeah. There are many successful gold standards that have worked at 20% coverage or 30 or 40% coverage. But the point is, even 25% coverage would imply a $20,000 an ounce gold price, which is a long way from 2,700. So gold, if gold is going to be used as money again, it is deeply undervalued.
Gold prices edged higher on Tuesday, recovering from their lowest point over a week earlier in the session. The dip came as safe haven demand waned, spurred by optimism surrounding a potential ceasefire between Israel and Hezbollah militants in Lebanon. Despite the recent fluctuations, gold has surged an impressive 27.57% since the beginning of 2024. This marks a continuation of gold's bullish trajectory, with the precious metal hitting an all-time high of $2,790.07 in October 2024. However, gold mining stocks have not mirrored the metal's impressive gains. Historically, gold stocks tend to amplify gold's price movements, often rising 2 to 3 times as much as the underlying commodity. Yet, as Lawrence Lepard, founder of Equity Management Associates, points out, this correlation has faltered. For example, shares of Barrick Gold, one of the largest mining companies, have only risen 19% over the past year, underperforming the nearly 30% rally in spot gold prices. Lepard suggests that this discrepancy stems from lingering skepticism in the market. Many investors remain unconvinced of gold's long-term strength, expecting prices to decrease. Nevertheless, Lepard is optimistic that this sentiment will shift as the reality of persistent inflation and unresolved fiscal challenges becomes undeniable. He predicts gold could breach $3,000 within the next 6 months and reach $4,000 to $5,000 by the end of this cycle, with even loftier prices possible over the longer term. Looking ahead, geopolitical developments and U.S. economic indicators will play a pivotal role in shaping gold's next moves. Investors focus on Wednesday's U.S. inflation data as markets assess the Federal Reserve's future policy direction. The Thanksgiving holiday-shortened week has also prompted profit-taking among gold buyers, adding to the volatility. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Particularly, I mean, I noticed in the gold space, the gold stocks, as you know, and as I've talked about other podcasts, really haven't responded the way they should have. Gold's up 30%, the stocks are up 30%. Typically, the stocks are 2 to 3x the gain of the underlying metal. And in this case, that has not happened. And the reason for that is if you go on Bloomberg and you check the future forecast, nobody thinks the gold move is real. Everybody thinks, oh yeah, it's at 26, but it's coming back to 2,000. And the ASICs, which is the all-in sustaining cost of mining an ounce, are going to continue to march up with inflation. $2,000, pretty soon your margins are gone, right? And so what's got to happen is there's got to be a shift in psychology where people say, oh, this is the real deal. And gold's not stopping at 25 or 26. Gold's going to 3, and then it's going to 4, and then it's going to 5. And I think those things are happening, obviously, over a course of several years. But until they get this fiscal thing solved, and it's not an easy fix, to me, it's very, very clear that we've got inflation in our future. I'm not the best guy to talk to about the dollar. I mean, I really respect the shit out of Brent Johnson and Santiago, and his theory is damn right. I mean, and a lot of people say, hey, the U.S. dollar will never hyperinflate, all these others will go for it. They could be right. I'm not an FX guy. I'm kind of a stock guy, and I look at, and I'm a sound money guy. Right. And so, to me, what the dollar is compared to the euro or the yen or I don't know, I don't care. What I care about is what's the dollar compared to alternatives to the dollar, and the alternatives to the dollar that are to me the most obvious are gold and Bitcoin, and so those are, and to an extent the yield on bond. So those to me are kind of how I measure how the dollar is doing. There's no bigger gold bull than me. I mean, I think we're going to 3,000 within the next 6 months. I think we're going to breach that. We need to. Gold is so deeply undervalued, it's insane. It needs to be in a different zip code. So I see 4,000, 5,000. At the end of the cycle, it could be 20, 40, 50. I mean, which sounds absurd, but it's not. It's really not. I mean, if you take it and if you did the math the way we did it in 71 when we were on a gold standard, Brent's done this actually, you'd need to be at $79,000 per ounce gold to balance the out. And that's assuming we have the 261 million
Dive
ounces.
into that a bit. Break that into it.
Yeah. So just take the broad monetary aggregates from the 60s. Right. Divide U.S. theoretically has 261.5 million ounces of gold. Okay. And I say theoretically because, I mean, Ron Paul personally said to me, I'm sure we don't have it. Yeah. Okay. So, but all right, fine. Let's assume we do. Okay, for the sake of argument.
The U.S. Federal Reserve has continued its easing cycle with a series of rate cuts in recent years, the latest being a substantial 50 basis points reduction just weeks ago. While this move aims to support economic stability, it has ignited concerns about potential disruptions in financial markets, particularly in money market funds. According to Apollo Global Management's chief economist, Torsten Slok, the Fed's rate cuts could trigger a massive $2 trillion exodus from money market funds, which recently reached a record $7 trillion in assets. As yields on these traditionally safe investments decline, investors will likely redirect their funds toward higher-yielding assets, potentially fueling volatility and asset reallocation across portfolios. This shift underscores the delicate balancing act the Federal Reserve faces. Lawrence argues that the Fed is effectively trapped in a cycle of inflation and intervention. When financial instability arises, as it inevitably does, the Fed prioritizes immediate economic stability over long-term fiscal responsibility. This approach often leads to increased money printing, justified as a necessary response to crises, perpetuating economic inflationary pressures. The implications of the Fed's actions extend beyond money market funds. Largely moving capital into higher risk or alternative assets could reshape financial markets and potentially inflate asset bubbles. Additionally, the broader economic consequences of these rate cuts remain a concern. While lower interest rates aim to stimulate borrowing and economic growth, they may also exacerbate inflationary pressures and undermine confidence in the Fed's ability to maintain long-term monetary discipline. Let's get back to the interview.
Well, the Fed's in a real box, okay, and you know, to me, it's unclear how they're going to solve it. But I think all roads lead to inflation. I think Paul Tudor Jones said that, and I believe he's correct. And we know that they want to try and portray themselves as inflation fighters, and they have. Powell's tried to, he's tried to channel, Volcker, but can he continue that? He's tried. Yeah, well, he did for quite a while. He raised really quickly, but. But here's what I do know. I do know that if and when something breaks, the third Fed mandate is continued financial stability, right? And we've seen it constantly. We saw it with Silicon Valley. We saw it with the repo blowout in 2019. We saw it with, just the higher yields on the 10-year in the fall of 2023. When things get dicey, what do? They go to the only tool they got. I mean, to them, they got a hammer and everything looks like a nail. and that's the printer. So, but what I can't tell you is I don't know when things are going to get dicey. I just don't know. But I have an extremely, in my, and this is just my personal opinion, I've been wrong a lot, okay? But I have a very high conviction level that the math is compelling that they will get dicey at some point. And I kind of put the outer limit on the diciness at 2 years. There's no way they can keep this going for the next couple of years. But I've been wrong about that before too. I mean, in 2008, I thought we were going to have a much longer crisis, and they did a lot of sneaky things that managed to hide the inflation, put it into the assets, not in CPI. I mean, in 2008, I thought we were going to have huge CPI inflation. We didn't, and we didn't because they changed the rules and allowed them to pay interest on excess reserves, and so all the money got stopped up at the banks, and then it went into the assets. So. Yeah, it's
a bunch of politics too.
Yeah, there'll be a bunch of politics too. I mean. It's very interesting as we watch who they're trying to pick a Treasury Secretary, right? We watch who they're going to pick. Clearly, the most intelligent and thoughtful guy would be Bessent. But, I think Elon wants to break a lot of glass. And he wants to get in there and just start, cutting away at everything. And, okay, I mean, that's fine. And there's an argument that a lot needs to be cut. But guess what? If you do that, the stock market's going to, you don't do that without having a serious economic downturn, right?
There's got to be consequences.
Yeah, so back again to my initial point, which is they're trapped. I just don't see how they get out of this. And what the path is so hard to know. Nobody knows. But it does, because we don't think they'll let the economy collapse. I mean, they're not going to get to the stage where we say, well, forget about it. We're just saying, we're not going to let the ATMs work, right? When push comes to shove and financial distress is present, they will say this is a crisis and therefore we have to print the money.
Gold's recent fluctuations highlight the delicate interplay between short-term market reactions and its enduring appeal as a safe haven asset. While monetary policy expectations and profit-taking create temporary headwinds, persistent geopolitical tensions and economic uncertainties strengthen gold's long-term prospects. These dynamics suggest opportunities for strategic accumulation during periods of correction. How can investors balance short-term market pressures with the long-term value of gold as a strategic asset in their portfolios? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.